Good evening. This is Ken Long from Tortoise Capital Management with the Easter edition of the weekend reports and the daily trading plan. We have a market that's in bullish normal conditions. On an annual basis at 66, it is slightly above average on the weekly RSI. 95 on the 10-day index is bullish, but overbought conditions. Looking at the market mosaic, the percent stretch above the 200-day moving average is back into the in the white at 10.83%. That's bullish. However, the slope of the 50-day moving average is almost flat at 0.08, which is relatively weak looking at the last 6 months, and so we consider that bearish. ADX remains weak at 14.3, but we'll see that plus DI is now better than minus DI. And so the weakness has moved from primarily bearish price action to bullish price action. ATR percentage at 0.98 remains at the low end of normal. All the equities have returned back up vicinity their previous swing highs of about 6 weeks ago. In the case of SPY, that's up around 134. There is strength returning to emerging markets in Asia. The current leaders remain precious metals, especially silver. Any commodities and energy are doing well. The rebalancing project for monthly and quarterly is not due until 1 May, and you can see we're still holding DIA, MDY, and IWM in the 331 and the 333 quarterly, and the 631 is holding SPY, MDY, and IWM. Excuse me. On ETF2, there's no changes this week other than to raise our protective stops. The theoretical exposure of the model remains at 90%, with 9 out of the 10 indexes positive on a 5-week rate of return. Only Japan is negative. So that leaves us at 90% recommended exposure, and the model portfolio is at 90%. Moving on to the market health check. Vertical blue lines are 10, 20, and 30-day look-back periods. The horizontal purple line is the previous swing high at 135 from about 16 or 18 February. You can see we had a big sell-off, a rebound, a lazy W sell-off, and now we're back up to vicinity of a third test of that 135 range in SPY. The horizontal red lines, the first one is a 5% pullback from the previous swing high at about 128.5. And the second red line would normally be drawn 10% from that swing high to show the boundary of a bullish correction. But that would be slightly off the chart. The center black line is the regression line, 30-day regression line, and the outer black lines represent the channel of the regression line based on the furthest venture from the regression line itself, which happened in mid-March, and that defines the channel. ADX remains below 15, but you can see the plus DI has moved above minus DI. With ADX that low, we have a very weak or untrending market, which means that if we can get some buying pressure here in SPY and continued strength into technology that we saw this week, we're in position for another 8% to 10% leg up to make the third leg of this bullish market that started last year in the summertime. We have price better than the 10-day moving average, which is this green line. And the 10 is better than the 50, and the 50 is better than the 200. That's the definition of a bullish market, and what we have is a triple test of the high and a set of lazy W higher lows, and that's favorable for the long side. You can see in Williams percent R10, we're in overbought conditions, and we're firmly in overbought conditions on the annual basis. Quick look at the top 10 regions of the ETF2 database. Again, only Japan is negative on a 5-week rate of return, so that leaves 9 out of 10 positive. That's why we're 90% theoretical exposure. SPY is slightly better than EFA. That's 37 to 36. The strength in the U.S. is in mid caps at 41, then technology at 38, small caps at 38, and large caps in SPY at 37. The two strongest sectors remain EPP, Asia less Japan, and U.S. mid caps at 41. And the weakest sectors, Japan and Latin America at 31. World market model, little change from last week, except a little bit more weakness inside the U.S. Any growth symbol or ETF is doing well in the U.S. Both large, medium, and small caps are doing fine. In Asia, Japan at the bottom of the barrel at 15, with Asia less Japan in the green at 35. So you can see just how differentiated Asia has become. And then among the Asian countries, you can see the leaders: China, Australia, Singapore, and Taiwan, and South Korea, and with weakness in India and Malaysia. Latin America, weak. Emerging markets, slightly above average. The countries of the Western Hemisphere, also slightly below average. Real differentiation in Europe with Sweden, Germany, Belgium, and Switzerland in the green. The energy sector has come out of the yellow to get back into the white status at 25, as you can see. Overseas materials, global materials, doing very well. The only business sector that's coded in the green based on their percent strength. $100 by 200 crossover system. Fewer defensive sectors are in cash anymore. Financials, utilities, treasuries, and Japan and Latin America are the only ones on a cash signal. Everything else is favorable on intermediate technical indicators like the 50 and the 200-day moving average. Top 30 in the ETF2 database, dominated by silver and precious metals. You see some biotechnology and biotech, and energy in the form of dynamic oil and gas, and then the blended power shares community ETF, which is DBC. That one is predominantly energy, and so as long as energy does well, DBC should do very well. ETF liquidity report. These are the top 30 by daily dollar volume. I would draw your attention to gold and silver, which have moved up into 5th and 6th place respectively, past EFA, past emerging markets, and past the energy sector, to trail only EEM, the Qs, the small caps, and the S&P 500. So that's quite a remarkable increase in the average daily dollar volume being traded in silver and gold. I'm in silver, but I respect how quickly profits can be taken, and that market is so small. It doesn't take much concerted selling pressure to reverse a very long trend. So that's the weekend report review. I'm going to move on to the daily next.